Welcome to Motley Fool Money. I'm Chris Hill, and we are not at Fool Global headquarters. We are not, Ron. We are on stage live from the Kogod School of Business at American University in Washington, D.C. We got a live audience. I think they're alive. I think they're awake. Okay, fantastic. My shameless solicitation for applause there.
One of the finest looking audiences I think I've ever seen.
And incredibly handsome, and yes. Joining me on stage, Charly Travers, Jason Moser, and Ron Gross. We got a great show this week. We've got Google hitting a new high, Apple hitting a new low. We've got Dell Computer caught somewhere in between. We've got Motley Fool co-founder David Gardner, who's going to share his thoughts on emerging technologies. And later in the show, we've got 3 students who are going to come up on stage and share the stocks that are on their radar. But we begin this week with the market writ large. This week, the Dow hit an all-time high run. It's the highest point the Dow's been at since October 2007. What do you think about this? Does it get you nervous? Does it get you excited? There are some people out there saying this is a sign of a bubble.
Well, if you don't like money, this isn't for you.
Right.
But if you're a fan of money, it's a nice thing to happen. So a few things are happening. I think we have to look at what's happening and does it matter to us. What's happened is that corporate profits have recovered really nicely since the Great Recession, and the stock market has followed suit. That makes perfect sense. But there's a couple of things that are happening. One, companies are not hiring, so they're keeping their expenses really lean and mean, and that's helping profits, which are great, but it's not helping the country get people back to work. The second thing is that the Fed, through various quantitative easing programs, has made it basically there's no place to go but stocks. There's no yield to make anywhere else, and that's driven people into stocks. So you have stocks being the demand for stocks, I should say, being, let's say, artificially inflated there. So does it matter? What do? Do we start trading in at stocks? Do we try to time the market? For foolish investors like us, the answer is absolutely not. We're long-term investors. We buy good companies. We hold them for the long term. We let the market, we let the Fed do whatever they're going to do, but we stay invested.
Yeah, Jason, what about that? To the point of the whole notion of the Fed, and as we've talked about before, this whole free money forever, to what extent does that get you nervous?
Well, I think it's a fair statement to say we should be at least a little bit nervous. I mean, I was looking back at Ben Bernanke's white paper at the beginning of 2012. He's talking about the state of the housing market, and essentially since 2007, there's about $7 trillion of wealth that was erased from the U.S. household due to the recession, due to the tank in stocks and unemployment and whatnot. We've seen a recovery to a degree back to the highest level here of U.S. net worth. Household net worth here at about $66 trillion today, which I think sort of helps prop up the stock market a little bit. There's some money to buy those stocks, and unemployment's coming down slightly, a little bit. I think there's still plenty of things to be concerned about, and I think that's why we probably all look at these recent market highs with just a little bit of trepidation.
Yeah, and then, Charlie, it's certainly gotten tons of attention. CNBC, essentially for a couple of weeks now, has had sort of almost like a countdown clock, just waiting for the moment when the Dow hit a new all-time high. Are there stories that aren't getting as much coverage? Or are there stories that are as meaningful to investors that are sort of under the radar?
I'm always much more interested in what CEOs are saying about the state of their business, particularly bellwether stocks like American Express or Walmart or UPS. So when a company like Walmart says they had a very soft February, that gets my attention a lot more than what's going on with what the market itself is doing.
I'll turn back to you, Ron, because you're the value guy on the stage. Are opportunities harder to come by when it comes to finding value in stocks?
Yeah, as a value guy, I much prefer to talk about one company at a time instead of markets, but since you asked, and we've got some time to kill. So the Dow is currently trading at about a PE of about 18. Not dirt cheap, not real expensive either. There are some great companies in the Dow, and for long-term investors, as I said, you buy them at reasonable prices and hold them and you'll do just fine. I think if you're looking for some more growth, you can go to some smaller companies that aren't as well known as the Dow stocks and find great companies there. But there's always companies to find. Certainly when stocks get a little bit frothy, they're a little bit harder to find for real serious value guys. But if you're willing to pay a fair price, there's plenty of companies.
The 2 biggest technology stocks making news this week, shares of Google hitting an all-time high, meanwhile Apple hitting another new 52-week low. Charlie, let's start with Google. I know this is a stock that you watch closely. When you look at it, I mean, it's great to hit an all-time high, but again, kind of like the market, there are people who look at that and think it's a time to run. What do you think of value, or what do you think of Google in terms of the value of the stock?
I think you have to look at the type of business you own. Some of the tech companies in the past that hit those all-time highs and then their stocks didn't do very well might not necessarily have had the most innovative of business models, and I'll reference Dell and Microsoft in particular, which got really frothy a decade ago and then the stocks didn't do so well. And I think that was because they were really great at doing one thing and not so great at innovating beyond that. I think the opposite is the case with Google. Yes, the stock is high, but it's only at 30-something times earnings. And this is for what I consider to be one of the most innovative companies in America. I think what they excel at is trying new things, whether it's fiber optics in Kansas City or Google Glass, and getting them out to market. And so a company like that that can constantly do new things, I think is going to be just fine.
And Jason, on the flip side, when you talk about the most innovative technology companies, that's a mantle that Apple held for years. And it seems like some of the luster is gone. And I'm not just talking about the drop in the stock, but just sort of the products. It seems like, you know, for lack of a better phrase, the cool factor is gone for Apple. And I'm wondering if you think that's overblown, or if they really are now in the position of they need a hit record.
If you are trying to tell me that my iPod and my iPad and my iPhone are less cool now than they were a month ago, I would question that. I think they're just as cool. I think the cool factor really is, I think it's a good example of the psychology of the market. You know, for a long time, Apple was the king of the hill. The problem with device makers when you're the king of the hill is there's always someone trying to knock you off the hill. So with Apple, I mean, you look at the market as a forward-looking mechanism. We have the iPhone and the iPad have made just a tremendous impact in our lives here in the United States. It's certainly playing out around the world as well. But the problem is, with the market looking forward, they want to know what's next. And so with Steve Jobs, there was a little bit of a sort of a wonder factor there, and you knew he was going to come up with something special. We just didn't know what it was. I think there's, you know, some legitimate questions to whether Tim Cook has that in his mind. But, you know, I think that when you look at things like whether it's the iWatch or whether it's an iTV or something, you look at Apple, it's one of the most innovative companies out there. It touches so many consumers. And today, when you look at the stock price in relation to the amount of cash that the company generates, you have to really be interested in the stock, I think.
Yeah, but Ron, so much of that cash, so much of that $140 billion in cash is overseas.
That is true. So, and if you run valuation models, you need to account for that. But there's still plenty of cash here that they can use for investments, use it return to shareholders. I think because of the silliness, quite frankly, of traditional Wall Street, the hedge funds and the mutual funds, they rotate out of Apple, they rotate into Google. Google's now one of the top-held stocks because of that rotation. It makes it feel like Apple is out of favor. The stock's trading at 10 times earnings, but grew 61% in its most recent year. The stock's a screaming buy at these prices.
Charlie, back to Google for a second, because one of the other stories this week is these reports that Google is getting ready to launch a same-day delivery service called Google Shopping Express.
What could go wrong with that?
And so, yeah, exactly. So for an annual fee, slightly less than apparently what Amazon Prime's fee is, you can get same-day delivery from Walmart, Target, Safeway. I don't know, is this a good, I realize that Google has plenty of cash and they can make small bets, but is this really a good idea?
Going up against Amazon, one of my favorite companies, I say probably not. But what I do admire about Google and companies that do similar things is the willingness to take small, calculated risks and see what works.
Shares of Penney fell more than 15% early this week after it was revealed that Vornado Realty Trust sold 10 million shares of Penney stock. And this is key, Jason, for two reasons. One, that was about half of the stake that Vornado had. And the second reason is that the guy running Vornado also sitting on the board of directors at Penney.
Yeah, I think we can probably expect that to come to a close.
So rather than try and fix the company from the inside, he's like, no, we're just going to sell the stock.
Well, and I think rightfully so. I mean, we're looking at a company here that's really lost its way. It's lost its identity. And I mean, they turned in a performance last quarter with negative 30+% comps, which is just unheard of. But again, I mean, I go back to 30 years ago, maybe Penney had an identity there. It was sort of an anchor for malls. But today, you have to really wonder what in the world it's doing. What are they selling and who are they targeting? And I think that's one of the problems. And Ron Johnson, for everything that he did at Apple, which is obviously very commendable, but that wasn't a turnaround situation. And so I go back to this with Penney. He was brought in for a turnaround, and I don't necessarily think he had the experience necessary to turn the ship around. And I'm not saying it was turnaroundable. I mean, I think now at this point you might just throw a Chipotle in a JCPenney. You could probably create more traffic. But at this point in the game, I don't know there's really anything they can do.
You've been an activist investor in the past, Ron. When you look at a company like this seems like it is a situation ripe for an activist to come in and, among other things, agitate for a new CEO. And I know he's only been on the job for less than a year and a half, but the drumbeat that Ron Johnson has got to go is getting louder.
Absolutely. You know, the heads of the larger retail companies, it's kind of a small group of people, and they all know each other and, for the most part, respect each other. And I found it extremely interesting that yesterday Alan Questrom, one of the most respected retailers, heads of JCPenney in the past, Barney's, Federated, Neiman Marcus, came out and said the board must take action. Ron Johnson is not a reliable source any longer. So to hear that come from him with his knowledge of the retail space, I think that speaks volumes, and a change is necessary. And retail's a tough business. I'm not sure the world needs JCPenney, certainly not with the large footprint they have now.
The last time we talked about Dell Computer, the company was set to go private, and this week, activist investor Carl Icahn, who owns 6% of Dell, said that they should stay public, pay out a one-time dividend of $9 a share, they should restructure. And then, Ron, we saw Jim Chanos, the famous short seller, come out and say that this business is just falling apart, and that's why he's shorting it. What is all the drama? If you're Michael Dell, you're pulling what's left of your hair out.
Two sides to every trade, and then you have Michael Dell. Listen, the $13.65 that they're trying to take it private for is probably on the light side. Obviously, you want to take a company private as cheaply as you possibly can. Carl Icahn coming out and saying the stock is worth closer to 23, that's probably on the high side. The truth probably lies somewhere in the middle. I don't know if I'd be shorting a company that has theoretically a deal on the table to go private. There's some risk associated with that, certainly. But for Dell, any investment in Dell is a bet on the future. You can't look at its current cash flows and say, I like it, because the business is completely restructuring. The PC business is hurting, and they're trying to kind of pull an IBM, if you will, and turn themselves into a service and server business. And that's all based on the future, and you either have to understand that future or you just have to stay away.
How is this all going to end? I'm asking you to look into your crystal ball as a longtime Dell shareholder. Like, is this just a lot of noise, and eventually Michael Dell's going to get his wish and the company goes private?
Yeah, I think that does happen. Perhaps they'll increase their offer a bit. This is what's called a go shop time right now, where other people can come in and make offers. Perhaps the board goes back to say, you need to sweeten your offer a bit. This is a bit light, but I do think it ends up going private.
Coming up, forget the CEO of 2013. We've got the early frontrunner for employee of 2013. Stay right here. You're listening to Motley Fool Money. Welcome back to Motley Fool Money. Chris Hill here on stage with Jason Moser, Charly Travers, and Ron Gross at the Kogod School of Business at American University in Washington, D.C. Late last week, Warren Buffett came out with his annual letter to shareholders. And Jason, there's a lot of stuff to dig into anytime Warren Buffett comes out with his annual shareholder letter. The thing I loved was the shot that he took at CEOs, basically telling CEOs, stop whining about market uncertainty and start allocating some capital. But what were the highlights for you?
Yeah, I love that. I mean, he's telling people to get out there and spend. He's showing us that Berkshire Hathaway is spending a lot of money. I mean, there are a lot of takeaways from that letter. And, having been to the annual meeting last year, I enjoyed reading his take on newspapers. He talked about that last year at the meeting. But I think what I really got a kick out of was sort of he took us through on the model of insurance companies and how a lot of these insurance companies run very bond-heavy portfolios. And a lot of these bonds are going to be rolling off legacy bonds, he referred to them as. And so they're bonds with higher rates of return at this point because they're so old. And that as they roll off, they're either going to have to do one of two things. They're either going to have to find a new way to earn a better return, or if they reinvest them in bonds at the rate that bonds are today, these insurance companies were looking at a considerable smaller rate of return for the foreseeable future. And so I think it's really, when you look at a company like a Berkshire Hathaway or even a Markel Insurance, which we talk a lot about at the Fool, it shows the importance of with insurance companies, what they're able to do with that float, management teams like they have at Berkshire Hathaway and Markel. Not every insurance company is created equal, and when you find really talented investing squads, you can stick with them for long periods of time.
One of the other things from the letter, Ron, was Buffett's praise for a couple of his lieutenants, Todd Combs, Ted Weschler, who, as he pointed out, had better years than he did in managing their portfolios. And if you're a Berkshire shareholder and you're worried about what's going to happen when Warren Buffett and Charlie Munger are gone, you've got to feel good about that.
Yeah, good stuff. I think he said that he's going to increase the capital that they each manage to $5 billion. Great that he has faith in them. He says they both crushed the S&P 500 in 1 year, but hey, it's better than not crushing it. So I think that's great for succession.
Jason, one other thing was, when Buffett talks about the stocks that he's looking to buy more of, it's not exactly, state secret stocks. We're not talking penny stocks here. It's Coca-Cola, IBM, Wells Fargo, American Express. Does that do anything for you as an investor? Do you look at that and think increasingly about buying those shares, or is that just Buffett and his world?
Well, that's definitely something that that's certainly within his circle of competence. He and Charlie Munger talk a lot about that, investing in companies they know and understand. And that's certainly something we espouse at the Motley Fool, too. I think that there's a perception out there that the tougher the investment thesis, it must be a better investment. And if I can't understand it, then wow, it's got to be a great investment. It's just going to return a lot of money. And that's just not really the case. And so we don't have any problem at all taking the too hard to invest in and throwing out there and just finding those sort of easy little hurdles to step over. And so that's, we're used to seeing that from Buffett time and time again. And I would expect to see the same once he hands the reins fully over to Combs and Westler.
What had been the worst kept secret in the media industry was made official this week when News Corp announced the launch of Fox Sports 1, a national sports network. Charlie, given the cash cow that ESPN has been for Disney, to what extent are the people at Disney and ESPN at all nervous about this? And to what extent do they just say, you know what, we're ESPN, we're fine? ESPN is by far the most valuable station on cable, so I think they're okay for the time being. But if you've seen the success that Fox Sport has had on Fox, particularly with the NFL, this is a very serious channel that they are developing. They have college basketball and football rights. They get Major League Baseball. So they have very valuable sports that people want to watch. Sports is the only part of the traditional broadcasting model that is not broken. If you look at what Netflix and Hulu have done to traditional TV shows, that game is over, but live sports is the one type of programming where advertisers still find it very valuable. So I think they're going to do very well here. Well, they've got the advertising, and they've also got presumably the subscriber fees. Now, ESPN, I think at the moment, it generates about $5 per subscriber. Fox isn't going to get that right out of the gate. I think it's closer to, the analysts are estimating it's going to be closer to $1, but presumably that would rise over time. When you consider the fact that News Corp, and I was actually surprised to learn this, has beaten the market. That stock has beaten the market over the last 1, 2, 5 years. Does this just sort of pad what they're already doing?
Right, so the projections I was seeing, they'd started at about $1 and change on the affiliate fees, and that's going to go up to over $2. Their profits are going to explode off of this.
Now that they have Regis Philbin.
Right.
Yeah, I'll be honest, I was a little stunned that at 81 years old, Regis Philbin was not only stepping back into the world of TV, but sports. Yeah, that's...
Go figure.
You know what? Don't bet against Regis.
Yeah.
You can never bet against Regis. Finally, late on Saturday night, a man tried to rob a Dunkin' Donuts in West Haven, Connecticut by climbing through a drive-through window. Acting quickly, an employee grabbed a fresh pot of hot coffee and threw it in his face. When the man got back in his truck and drove away, she yelled after him, and I love this part, "Go run on Dunkin'." How great is that? I mean, if you're the CEO of Dunkin' Brands, aren't you tracking this woman down and immediately giving her some sort of amazing spot bonus?
I think you have to. I mean, this story to me, when you compare this story along with the one we talked about earlier with the guy getting nailed for stealing the Girl Scout cookies money.
Yes.
I mean, you put those two stories together, it makes you wonder what in the world's really coming to. But the fact that you have an employee out there that would actually do that, I think that takes a lot
Initiative, thinks on
of
her feet.
courage.
And I love Starbucks, but Starbucks baristas aren't doing this. They're just not. I just don't see that in them, in part because they don't have pots of coffee.
Well, at first she threw a cup of coffee and then just started chucking pots.
She's a go-getter.
Yeah.
Well, and as investors, we like to see that. We like to see passionate leadership, passionate
Does it make you a little bit more bullish on Dunkin' Donuts, Chris?
I'm putting
That's not possible. He's already.
I'm very bullish, but
You're like
I'm
the Uber
just
Bowl.
bumping it up my watch list.